Hello and welcome to AE Accounting Tutorials. Today we are beginning a new series on IAS 36, Impairment of Assets. In this particular series, we'll be looking at the various subtopics into different parts. But in this particular part or this particular video, I want us to look at the basic concept with regards to IAS 36. That is the objective of this standard, the scope of this standard, and some basic terms that we need to understand or know under IAS 36. Okay, after that then we take a full practice question and try to enhance our understanding on how to test for impairment of an asset. So the objective of IAS 36 is to outline the procedures that an entity should apply to ensure that the carrying value of all its assets, it is not stated above the recoverable amount of such asset. Is that okay? So the key words here are the carrying amount or carrying value and that of the recoverable amount. So we have the carrying values or the carrying amount. Then we have the recoverable amount. So the meaning of this objective is that an entity shouldn't recognize its asset carrying amount above its recoverable amount. Okay, and I'll explain this into details. So for instance, when the carrying amount of an asset is 1,000, let's say this, okay, and then the recoverable amount is 800. See this. It is the carrying amount of an asset that we normally recognize in the statement of financial position. That is the value of the assets, okay? But when we continue to use the assets, the cash flows that the asset will generate to us might not be the same as that of the carrying amount. Or when we decide to sell the assets at the end of its useful life, the proceeds that we ascertain as an entity may not be the same as the carrying amount of its assets. And this standard is saying that we shouldn't recognize an asset in the statement of financial position greater than its recoverable amount. The recoverable amount is its fair value. Is that okay? So if we want to use the assets, okay, for some number of time, the cash flows that this asset will generate to us is 800. Or let's say when we want to sell the asset at the end of its useful life, the proceed that we will get is 800. Then why should we deceive ourselves to recognize 1,000 as its carrying amount? That is why this standard came in to say that we should test for impairment for some particular asset at the end of every year to determine the impairment loss so that the asset should not be recognized above its recoverable amount. So these are some terms I will explain along the line. Is that okay? So I just want you to understand the basic concept with regards to IAS 36 before we look at it into details. Is that okay? IAS 36 states that at the end of every financial year, an entity should test for impairment for its assets. But remember, not all assets that can be tested for impairment. Is that okay? So because of this, I would like us to learn about the scope of this standard so that we know some inclusion and exclusion to this standard. There are some assets that we can't test for impairment. So let's look at the scope. So the scope of IAS 36. I'm to talk about the exclusion. IAS 36 does not apply to this particular asset I'm about to list. So in an examination, when you meet any of these assets I'm to talk about, you can test for an impairment, okay? And I'll also talk about some assets that you can test for impairment. So the first I can talk about is inventory. An asset of inventory. And an asset of inventory is regulated by the IAS 2. So an asset of inventory, we can test for an impairment, okay? And we can talk about biological assets. Biological assets. And this is IAS 41 in relation to agriculture. So if an asset is a biological asset, we can test for impairment. Is that okay? So we can also talk about investment properties. Investment property. So this is IAS 40 and we can test for impairment for it. And also we can also talk about construction contracts. Okay, so construction contract, and that is IAS 11. So an asset arising from construction contract, we can test for impairment. Is that okay? And we can also talk about employees benefits. Employees benefits. Employees benefits. That is IAS 19. So an asset arising from employees benefits, we can test for impairment as well. Is this clear? And we can also talk about deferred tax assets. Okay, so deferred tax assets, that is IAS 12. Okay, so an asset arising from deferred tax cannot be tested for impairment. Is that okay? And we can also talk about held for sale assets. So held for sale asset, held for sale asset, that is IFRS 5. All right, so an asset held for sale and discontinued operation, we can test for impairment. Okay, that is regulated by a different standard altogether, IFRS 5. And we can also talk about insurance contract. Okay, so insurance contract, that is IFRS 4. IFRS 4. So an asset arising from insurance contracts, we can't also test for impairment. And I can also talk about financial instruments. Financial instrument, that is IAS 39. All right, so that is an asset arising from a financial instrument, that is recognition and measurement of financial instruments. So these are some categories of assets that we can test for impairment. So in an examination, when you see any of these assets, don't tempt yourself to test for impairment. Okay, so apart from these assets, the remaining can be tested for impairment. For instance, okay, is the property, plant and equipment items. Is that okay? So let me say inclusion. Okay, inclusion to IAS 36. So for this group of assets, we can test for impairment. That is the property, plant and equipment items. So if it is land, we can test for impairment. If it is plant, we can test for impairment. If it is building, we can test for impairment. If it is intangibles, for instance, goodwill, okay, etc., we can test for impairment. So you have to know the exclusion and inclusion to IAS 36. So these 9 assets, you can test for impairment. So these are some basic exclusion to this standard. Okay, so after knowing this, let's look at some basic terms that we need to know. In financial reporting, the theoretical aspect is very key. If you don't understand the theoretical aspect, it will be very difficult for you to do the calculation. Impairment is one of the simplest topic in financial reporting. So let's look at some basic terms with regards to IAS 36. Okay, so with the basic terms under IAS 36, the first term I would like to talk about is cash generating unit. So we have something we call cash generating unit. We call it the CGU. Okay, cash generating unit. So what is cash generating unit? Okay, so cash generating unit, it is the smallest group of assets that generates cash flow from the continual use of the assets, okay, and does not depend on the cash flow of other assets. So any group of identifiable assets that generate cash flow on its own from the continual use of that asset without depending on the cash flow of other assets is what we call a cash generating unit. This is a different subtopic we may look at, okay? When we test for an impairment, we have to allocate the impairment to cash generating units, and we will do that another time. Is that okay? So that is the meaning of cash generating unit. I just want you to know the meaning of cash generating unit. So if we have, let's say we have land, we have building, we have goodwill, and the total is given, and this group of assets is able to generate cash flow to the entity from the continual use of this group of assets without depending on the cash flow of other assets, then we call this group of assets a cash generating unit. Okay, so when we test for an impairment for this overall or all these cash generating units, we can't just take out the total impairment we've tested for from the total. We have to allocate it to each individual asset, and we have criteria for doing that. So we will look at that also. Is that okay? So the next item I would like to talk about is a carrying amount. So most of these terms I have already explained them under IAS 16, property, plant and equipment. So we just need to do recap to enhance our understanding. So when we talk of carrying amount of an asset, a carrying amount of an asset, it is the amount at which an asset is recognized in the statement of financial position after deducting accumulated depreciation and any accumulated impairment. So that is what we call carrying amount. So I will say CA, being the carrying amount, has to do with the cost of the asset less accumulated depreciation less accumulated impairment. So when we do this adjustment, we arrive at what we call carrying amount. Okay, so that is the meaning of carrying amount, and we may look at accumulated depreciation, accumulated impairments, and all those stuff. Is that okay? So after that, let's talk about what we call the depreciation itself. This is just a recap because all these terms will be used in our calculation. So for depreciation has to do with the systematic allocation of a tangible non-current asset over its estimated useful life. So if the cost or the depreciable amount of a tangible non-current asset is, let's say, 100, then its useful life is 5 years. Then the depreciation per year will be 20. Is that okay? That has to do with the systematic allocation of the depreciable value of the tangible non-current asset over its useful life. So let's talk about amortization. Amortization too has to do with the systematic allocation of the cost of intangible asset over its estimated useful life. So for instance, if the cost of a goodwill is also 100 and the useful life is 5, then the amortized value for the goodwill will be 20. So for amortization goes with intangible assets, then for depreciation goes for the tangible asset. The next item I would like to talk about is fair value. Okay, fair value. Fair value. When we say fair value or fair value of an asset, is that okay? So it is the price at which an asset could be sold, okay, at the end of its useful life in an arm's length transaction, okay, between willing and knowledgeable parties. So the price at which you will sell an asset at the end of its useful life in an arm's length transaction is what we call the fair value of an asset. So if you acquired an asset, okay, and at the end of its useful life, you can dispose of the asset of 1,000 at a cost of 1,000, then this $1,000 becomes the fair value of the asset. Is that okay? Good. So after knowing fair value, there is something we call fair value less cost to sell. Fair value less cost to sell, or fair value less cost of disposal. Okay, this simply means that the fair value of the asset after taking out the cost you incurred in selling the asset is what we call fair value less cost to sell. So if the fair value of the asset is 1,000 and the cost you incurred in selling this asset is 200, then the 800 becomes the fair value less cost to sell. These are some key terms that we'll be using under IAS 36. So you pay attention to this. Is that okay? So after looking at fair value less cost to sell, we can also look at something we call value in use. Value in use. These are keywords or entity specific value. Or assessed value. So any of these three words mean the same. So I'll be using the value in use most. Is that okay? So when we talk of value in use of an asset, it has to do with the discounted present value of estimated future cash flows that an entity will raise or that an entity will get from the continual use of the asset or from the disposal of the asset at the end of its useful life. So what I'm trying to say is that the discounted present value of the estimated future cash flows that an entity will expect to get from the continual use of the asset or from its disposal at the end of its useful life. That is what we call value in use. So for instance, when we have an asset in 2023, okay, then at the end of its useful life, we can estimate when we want to sell this asset, we will sell it at a cost of $1,000. If that is the case, then this $1,000 becomes the value in use. Or when we estimate that in the next 3 years, the future cash flows that the asset will generate into the entity, when we discount it into today's term, then we call that value in use. We are discounting because of time value for money. So if this is 2023, sorry, this is 2023. So let's talk of 24, 25, and 26. So when we assume to get 100, 120, and then 130, is that okay? So when we add these three, then we discount it into today's term by using the discount factor, then we call that the value in use. Is that okay? Very good. So that is the meaning of value in use. So the next term I would like to talk about is the recoverable amount. Okay, so recoverable amount. Recoverable amount. What is a recoverable amount? Okay, recoverable amount has to do with the higher of fair value less cost to sell and value in use. Okay, the higher of these two. So the definition, the standard definition is that recoverable amount has to do with the higher of fair value less cost to sell and the value in use. Which one is higher? We pick it as the value in use. So let's say when we have a fair value less cost to sell being 1,000, then we have the value in use happens to be $1,200. Comparing these two, the value in use being 1,200 is the higher. Because the value in use is the higher, we pick the value in use, which is $1,200, as the recoverable amount. So recoverable amount has to do with the higher of fair value less cost to sell and the value in use. Is that okay? The last but not the least term I would like to talk about is impairment loss. Impairment loss. What is impairment loss? That is the topic for the day, impairment. So impairment loss has to do with the excess of the carrying amount of an asset over its recoverable amount. Okay, so that is the definition, the excess of the carrying amount of an asset over its recoverable amount. So this is, I've explained carrying amount and I've explained recoverable amount. So these are some key terms we will be talking about when we are explaining our concepts. Is that okay? So what we are saying is that impairment or impairment loss is given as carrying amount minus recoverable amount. So I can say that carrying amount being CA minus recoverable amount. So if the answer is positive, we call it impairment loss. That is the excess of the carrying amount of the asset over its recoverable amount. That is impairment loss. But if the recoverable amount exceeds the carrying amount, we don't have something like impairment gain. We don't have it. So there is no impairment. So in an examination, when the recoverable amount is greater than the carrying amount, we have no impairment. Okay. But in a subsequent video, or yes, in a subsequent video, we'll be looking at how to reverse impairment. That is where we'll be looking at when the recoverable amount is greater than the carrying amount. Is this clear? So these are some basic terms I just want you to understand before we take a question. But before that, I just want us to look at some indications, how to identify that an asset is impaired. So we'll be looking at some indications that may cause to an impairment loss. Is that okay? Before we take the question and try to solve the test for impairment. So the indication of impairment has to do with how or what will we see before we'll be able to identify that an asset is impaired. The first one is market value declined. When the market value of the asset declined. Is that okay? So we have the carrying amount being given, then the market value of the asset, that may be the price at which we will sell the asset, has fallen. So that will be the fair value of the asset. If it has fallen, that could be the recoverable amount. So if that happens, that is recoverable amount. And I said that the fair value less cost to sell, and then the value in use, we compare these two and pick the higher and push it up as recoverable amount. So let's say we have value in use to be 0 and the fair value of the asset initially is $100 and it has fallen to 80. Because it has fallen, it may cause an impairment. So when market value declines, it can cause for impairment. In an examination, they can ask you to mention some indication of impairment. And we can talk about increase in market interest rates. So increase in market interest rates. Okay, so when there is an increase in market interest rates, it can also lead to an impairment. Is that okay? So we can also talk about physical damage. Physical damage. Physical damage or obsolescence can also cause or it can also lead to an impairment. And we can also talk about worse economic performance than expected. Worse economic performance than expected can also lead to impairment loss. Is that okay? So these are some indications you need to know. So right after here, we have to take a practice question. Is that okay? And I need to pause here. In my subsequent video, I'm going to take a full practice question, try to solve with you to enhance your understanding. Is that okay? So just move forward to the part 2 to watch the video. Is that okay? On the calculation.